Fellas, oh my goodness. So, what I wanted to discuss today is a few questions that investors may potentially ask you when they're looking to invest with you in a multifamily deal and what that might look like. These are just random questions I kind of like came up with off the top of my head, some questions that I've gotten a bunch of times from different investors and how we kind of went about the combo, so to say. That's kind of what we're going to be talking about. So the first question here is the biggest question that most people are worried about when it comes to investing, and that's how long have you been in the business? How long have you been doing this? And how long have you been in the specific geographical or target market that you're currently in now? Because some people may have been doing it for a while, but they're pitching a new investor on a new deal that's in a market that they've never been in. And so really the best answer for that, at least the best answer that I've been able to use, if it's a market that, like, if I've been in the business for a little bit, so it's easy for me to answer that, as well as lean on my partner's experience and expertise as well. I'd say that's probably the biggest thing, especially early on. Even if you don't have partners early on, what I was able to do is even lean on my mentor. Be like, hey, I'm directly connected to this guy over here. Maybe he's not necessarily in my deal, but I've got direct access to him and he's done XYZ amount of deals. He's in this market, or maybe he's not in this market, or he knows people, or whatever the case was. I was able to kind of like lean off of my inner circle in terms of even just having that conversation, right? And that's just what it is. This is just a potential passive investor asking you a question about how long you've been in the business and what that kind of looks like. And this can go for anything. It's not just passive investors. This could be a broker talking to you when you're trying to get them to take you seriously and trying to get them to send you great opportunities. Like, well, how long have you been in the business? What kind of deals are you buying? Blah, 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 asking you questions like that. So I think one big thing was just leaning on your network, which for me at the time was business partners and mentor. And I had one guy, this wasn't an investor, this was a broker conversation. I was chatting with him over the phone, and I could tell the conversation was kind of going sideways, just like most of my broker conversations at the time, because this was before I had ever actually closed the deal. I'd had so many calls with different brokers, and this was just another one. He's asking me, what kind of assets do you like? BC class, you and every other guy, right? And I was trying to differentiate myself as best I could, but it was hard because I hadn't closed the deal. And so I just actually accidentally said that I knew my mentor at the time, and he was talking about a deal that he had just sold or was getting ready to sell. And I was like, oh yeah, I know that deal. My mentor actually owns that deal and was selling it. He's like I couldn't actually see his face because it was over the phone, but I could tell ears perked up, eyeballs got big. He got really interested in the conversation as soon as he knew that I knew this guy. I was like, oh my gosh, you know him? I'm like, yeah, he's my mentor for a while. And I'm just been learning as much as I can from him, trying to really dive into this business. And then immediately, like I said, I could tell that a switch had flipped. And when we got off the phone, he sent me like five deals he had in his inbox. And of course, none of the deals ended up panning out, but I underwrote every single one of them and got back with him in terms of like feedback of why I didn't feel like they made sense for us. But it was leaning on that I mean, almost like borrowing his credibility. Like, hey, yeah, I know you and your capacity to do stuff. I may have none of that. I don't really have any credibility or necessarily capacity, what I feel like right now, but I know you, I'm connected to you, and he knows you closely enough that he's like sold one of your deals or is in the process of doing so. And so when you're talking to brokers, when you're talking to investors, when you're having these conversations, I think the best thing to do is to lean on your network, lean on the people that are in your inner circle that have done this kind of stuff before. And if you don't have any of that, obviously you've got me now, so you can lean on me. But if they're still not convinced, not that you have to necessarily convince these people, but I think another thing to do is just to be open and honest. That speaks volumes sometimes with investors. Like when I was first starting to raise capital and I had never raised capital before, and I did that challenge that I told all you guys about and raised $6 million in 30 days. They would all ask, how many deals have you done? Tell me about your experience. Tell me about this. Tell me about that. I'm like, I don't have any experience. I have a mentor, but I haven't actually been able to close a deal yet. I only had one business partner at the time. I've got a business partner. He's been in the single family business for a while. I've done a fourplex. I not doing so great on it and like losing some money, but I've done a fourplex. If you really want to like follow my story on that, you can follow me on social media. But it was just being really open and transparent. And it was almost like they could sense the transparency, sense the honesty, and it made them want to know more about me, right? They didn't necessarily want to know more about the investing side of things because I didn't have much experience there, but they wanted to know and build a stronger relationship with me as an individual. So then from that kind of came the actual investing piece later on. They're like, you know what? If you had a deal and it looked like XYZ, like it looked like what we've been talking about today, you kind of pitched me an example scenario. I would definitely be interested in investing with you. And I was like, okay. And how much do you think you'd be interested in investing in? And here's the price or whatever. I know that was an extremely long tangent from one singular question, but that is my question and answer to that question. Question number 2 is, have you ever survived previous adverse market cycles? How did it work out for you? How did you handle it? Now, I have not. I still haven't. There hasn't really been much of a inverse fluctuation, except for now, what we're seeing now, what's happening. And so my best answer to that was, again, to kind of lean back into the network and be like, well, my business partner's been in the industry for a little over 10 years. He was in it back in 2010, 2011, 2012 when things dipped. He was flipping houses at the time. Here's how he kind of overcame those things. But then even outside of that, I'm like, no, I haven't necessarily been through an adverse market cycle, but I can tell you what we're doing right now to prevent from us actually, like if there was an adverse market cycle, right? I can tell you on the deals that we have done and on different things that we've done or people around me have done, here's what I would do, here's what I'm currently doing to help prevent that from happening, to help prevent if the market tanks and rents plateau and interest rates go crazy and this thing happens over here and the whole economy just collapses. You know what I'm saying? Like if all these different things happen, here is the way that we underwrite our deals. Here's how we underwrite conservatively. Of course, that's if they want to get really in depth into the conversation. If it's just a quick one-off question, then I lean more to just one, always being truthful and being like, no, I haven't actually been through that, but I've got this person over here that has, or if they haven't, it's like, we haven't done that, but here's what we're doing to prevent that. And then of course, the next piece of the question is, how did it work out or how did you handle it? It hasn't happened. So we haven't really had to handle it. But there has been a couple of chaotic things that have happened in a deal that we've had, not directly because of economic or a market cycle, but because of, like at one of our properties, it's a 148 unit portfolio, and one of the buildings, all of the plumbing pipes burst like at the same time. We had like 10 to 12 bursts in a 2-hour time frame, and the whole building flooded. We had to evict all the tenants, not because of non-renewal, because it was a catastrophic event, and we had to mitigate the water issue. But then they ended up suing us because we evicted them. It's this big long thing, right? But that would be an example scenario of like, okay, when something crazy happens, how are you going to overcome that? What are you going to do to make sure that you solve that problem? Are you just going to sit back and wait for, I don't know, the magic fairy to solve all your problems? Or do you have things in place, enough reserves set aside? Do you have these different things to make sure that my capital is safe? At the end of the day, all these questions they're asking you is because they want their capital to be safe. Yes, they're investing with you because they want to make money, but their biggest fear is that you're going to lose their money. So that is really what you're communicating about, is how are you actually going to protect their money and then actually make money with the money that you've given them, with these particular questions. The third question is, how have your previous deals performed compared to what you've projected? So are you shooting out pie in the sky numbers and not even coming anywhere close to what you're actually projecting? And that's how you're able to get all these investors, is because you're telling them you're going to make a ton of money, but then it never actually happens. And so early on, obviously, I was like, well, no, because again, I haven't necessarily done a deal, and I lost money on the first deal I did, but I didn't have other investors' capital in it. It was just me. But what I do have is an example scenario over here from from my mentor. We've gone over a couple of example scenarios of things that he's done, or from a particular partner that may or may not have already done a deal. Here's how that kind of panned out with that. And if you have none of that, if you have no partner that's done a deal before, if you have no anything like that to lean on, then I would just take it back to the underwriting concept and really get them feeling comfortable with your understanding and your knowledge of that particular market. When you're like, this is the market I'm in, here's why I believe this, this, and this, and why I believe rent can be here, and here's where it is currently. And of course, this is if you have a specific deal, but even if you don't have a deal and you're just having a conversation with them, making them feel comfortable with your ability and your knowledge of that particular market is really going to be the difference maker there. In my opinion, that's what I would have done when folks ask me this question, or what I did do when folks were asking me this question. I was like, well, no, not necessarily, but here's what we would do to make sure that we're mitigating this. Here's the insurance we would go with. I already have relationships with different insurance companies over here. Here's what it's going to cost versus here's what I know this particular property is already charging. So I know we can get it cheaper. I know we can do this over here. I know we can turn this lever. We can do that. Here's where rent can actually be. Here's why I know rent can be there. Here's a property management connection I have that will directly affect our ability to, of course, execute on the business plan that I'm telling you we're going to execute on. Here's the property manager's track record of different properties and different things that they've done before, and how I believe we're going to be able to do what I say we're going to be able to do because they've done it 100 times before with all these different properties. So you're really able to like lean on not only your network, but your knowledge as well of that market when they're asking about performance and projections. The next question is they'll ask you to explain your due diligence procedures. Can you tell me about how you do diligence? How you do due diligence? Can you tell me exactly how that process works? Can you tell me, are you actually having third-party contractors or professionals go out and walk on each roof? Are you just having a drone fly over? Are you having someone go in all the attics? Are you scoping the sewer lines? And maybe they're not asking this because they don't have a deep understanding of it, but they're just going to want to know, again, how are you going to mitigate the risk of this particular investment? How are you going to actually make sure that my capital is going to be secured, my capital is going to be safe, and you're going to potentially 2x it or 3x it or whatever your projections are for this deal. So at that point, you're really able to lean on, again, networking and different experience inside your network, but also third-party people you would potentially hire. So that would be, if you're looking to hire a potential third-party inspector for the due diligence process, say, I don't necessarily know the exact procedure we're going to go through because I haven't gone through one before. I can tell you what I've learned up to this point. I can tell you what we've like some of the systems we've kind of set up to do for what to do when we end up closing our first deal. But here's the company we're actually going to hire. Here's the process they tell me they're going to do, and they've done 100 times before, 10,000 times before on different deals. And so here's kind of what that process is going to look like. Here's all the things we're going to be looking for. We're going to be looking at ages. How old are the different appliances? Does it have aluminum wiring, copper wiring? We're going to be looking at all of these different things. And we're even going to be looking at the fire hydrant system, because believe it or not, when you buy a piece of property, you own the fire hydrant system on that piece of property. And so if it fails, you have to pay for it. And that's something most people don't know. So it's just a random little tidbit of knowledge there to say that we are going to do mass amounts of due diligence. And here's the exact process that we're going to go through to make sure this is actually a good purchase. The fifth question, next question, they could potentially ask or have asked me before in the past is, who performs the accounting function at your organization or for your company? And what is their level of experience? Now, I had zero experience in accounting when folks were asking me this question. So I'm like, this is definitely where I was leaning into the experience of my partners, and specifically one of my partners, Reggie, who had been in the single family industry for 10 years. I'm like, yeah, he's maybe not necessarily ever done multifamily, but here's his deep understanding of real estate and his deep understanding of accounting. And if you don't have that, then you can lean on a bookkeeper that you've hired to do all the accounting for you. Or if you're hiring a property manager and they have in-house bookkeeping, you can say, here's their level of experience and what they're going to do and how we're going to kind of tailor the accounting from this perspective. And then if they start asking you really specific accounting questions and you have no idea what they're asking, then that's when you can just be like, just obviously be honest with them and be like, look, I don't have a deep understanding of the whole accounting piece of this, but that's why we're hiring a professional, right? I don't want to just go into this willy nilly. I want to make sure we're doing this the right way. And that's why I'm hiring someone who has a deeper understanding of this. So if you'd like to learn more about our accounting function and how exactly we're going to go about doing that, and how you're going to receive your updates on a monthly or quarterly basis, financial updates, here is I can directly connect you with our accountant, or we can set up a Zoom call between the three of us or a phone call between the three of us. And any questions you may have about the way that we're going to do that, I'll be there to answer any questions, but specifically this professional who's going to help us out will be there to answer all your specific accounting questions. So that's how I would go about, I guess, combating that particular answer. Question number 6 is, what level of insurance are you going to get for the property? And of course, this can be asked many different ways, but basically, what kind of insurance are you getting? How much are you going to get the coverage for? What's that going to look like? And insurance has actually been extremely crazy over the last couple of years. There used to be a ton of carriers, specifically where I'm at in the coastal areas of kind of Louisiana, Mississippi, Alabama, and then Florida here down on the panhandle. There used to be a ton of carriers that would write for this area. Now there's only 3, because so many carriers have lost the capacity to be able to pay out large amounts of capital, because they've had, I think the statistic I think is over the last 5 years, each year they've paid out about $1 billion in payouts from different catastrophes, assault and battery, litigation things, hurricanes, floods, fires, all happening, I guess, more specifically in the catastrophic coastal zones of down here. So the premiums specifically over the last year or two have almost doubled or tripled. That's just a random tidbit of information there. It has nothing to do with, I guess, what I'm actually talking about. But in terms of actually answering this particular question, I would make them feel comfortable with your comprehension and understanding of insurance. Or again, if you don't, leverage someone who you're hiring to help you out with the insurance piece. And of course, mentors or partners or something like that. But specifically, if I were you, I would want to get a deeper understanding of how the insurance market works, because obviously you're going to have some kind of insurance broker, or you're going to be going direct to some kind of insurance company. And so when you're in communications with this individual, I would just be asking a ton of questions to make sure that you have a deep understanding, so that when you go out to talk to these investors to raise money and they're asking how much coverage are you going to get? What does that look like? Are we going to have enough for a deductible if something crazy happens? What is the deductible amount? It's okay with the deductibles, $20,000 or $10,000. But if it's wind damage, if it's a hurricane or something, then it's 1 or 2%. And so here's how much money we're setting aside in reserves, and here's how much money we're going to set aside in working capital to make sure that, worst case scenario, we always have that much money in the bank. If something crazy happens, we'll at least be able to pay the deductible. We'll at least be able to pay the 2% wind, whatever it is. So we'll always be in the green. We won't ever be in a position where it's like, oh my gosh, this massive, horrible thing happened, and we don't even have enough money to pay for the deductible. How are we going to get this? How are we going to get the insurance payout? And how are we going to fix this property? So you'll always have that level of reserves there. But then you'll make them feel comfortable with, well, also this particular property is, we're buying it for $2 million. We believe that the total build out, if this thing was to be torn down and have to be rebuilt again, it's probably only about, I don't know, $1.5 million, $2 million. We'll just say it's $2 million. Say it's probably about $2 million. So in order to give us a little buffer there and make sure that we're protecting the asset and protecting your capital at the end of the day, we're going to get it insured for $2.5 million. We're going to get insured for just a little bit more than we need. The premium is still within the realm of where our financial numbers fall out. You're still going to get the same returns we initially talked about, because we've already worked that into the financials. and we've got additional coverage than we believe that we actually need, again, based on our understanding of the market. Luke, are you trying to ask a question? Is that what this is?
Yes, I have a question. So you're talking about having deductibles set aside and reserves set aside beforehand. How much should you set aside?
It's going to vary for every deal, but
Yeah.
what we like to do is we like to, at the very minimum, set aside. It's kind of like rules of thumb. Like you could do 10% if you wanted to do 10%. Some people do that, but sometimes it's a little excessive depending on the size of the deal. Or you could do the specific. Let's say you had a $20,000 deductible that covered everything except wind and hail. And then wind and hail was 2%, which it's 2% of whatever the like cost of the
Replacement.
replacement of whatever it is. So if you're insuring it for 2.5 million, maybe 2% of that. So you may even go as far as making sure that you have that set aside as well, whatever that 2% is. So typically our reserves, what we like to do is we set aside $385 per door each year for reserves as we continue to go. And that was actually the standard and what was required by the lenders we were using early on. We were getting started back in 2020 and 2021, it was 385 door. So we've continued to use that because it's a very conservative number. And obviously that number has dropped since lending's gone ballistic, and maybe it'll come back up. I don't know, but we definitely feel that's a very comfortable number on an annual basis. So even before that, when you're actually going about raising the capital, that is where you would make sure that you have enough raised in reserves to cover the deductible, cover the 2%, and then cover any overages that you may have for CapEx. So if your CapEx is, you need $200,000 to do whatever you need to do, you may want to get an additional 10% on top, or 15 or 20% on top of the $200,000 that you need to throw away in additional reserves, specifically for CapEx, but also for any other crazy anomaly. So you'd have 10 to 20% on top of whatever the CapEx is, which we'll say it's 200,000. Then you'll have the 2% deductible. Then you'll have, or the 2%, whatever. And then the $20,000 deductible. And then you'll have the 385 coming out of cash flow every month or every year per unit. So that's what that would look. That's what we do anyway. That's what that would look like. So the next question, my phone's being weird, saying this is question 8, but it's question 7. Question 7, is your renovation budget based on contractor bids, your past experience, or just a wild guess? Because there's different stages where you may be at different levels of what that looks like. So when you're just getting started out, you have no past experience to be leaning on. So what you're going to be doing is you may be leaning a little bit more towards the wild guess, at least early on, right? When you're doing your preliminary underwriting of a deal, broker just sent you it. You just had a conversation with the seller direct or whatever. They send you the financials. You're not sending out contractors to do bids on this property. You're trying to get back with this individual within an hour or 2 hours or 3 hours to let them know if you're still potentially going to be interested in the opportunity. So when you're doing your initial underwriting there, if they're asking you specifically about that, let's say it's only been a week or 2 weeks and you're in the process of getting it under contract, you're under LOI now, and they're asking about your renovation budget, you can say, well, honestly, it's based on a little bit of a wild guess right now because we haven't actually bought a deal in this particular market before, but here's where I'm seeing things pan out based on maybe your previous experience in the single family space, or here's where I'm seeing things pan out based on, my mentor, my partner's been in this business before. Or if you have none of that, then you just lean on, it's a little bit of a wild guess, but I will say, here's where we comfortably think it's going to come in at. So we just went above and beyond that. We think it's going to be $200,000 that we need in renovations based on what we know needs to actually be replaced and fixed, of course, based on preliminary conversations with the seller or the broker. But then we went over an additional 100,000, or we went over an additional 200,000 in the CapEx, because these are just our preliminary numbers. And even with those preliminary numbers, it still looks like a great deal. It still looks like we'll be able to make some pretty good profit here. So that would be your wild guess, right? Early on when you're doing that preliminary stuff. But then the past experience, once you start gaining that experience, you can be like, yeah, we've closed deals before in this market a couple of times previously. And, here's what we know needs to be replaced. We've replaced these things 100 times before. And here's exactly how much these different things are going to cost. So we said, okay, it's going to be $2,000 door to replace all the kitchen cabinets. It's going to be, $2,000 a door to replace all the appliances. It's going to be whatever. And this is just kind of what we've come to find to be truthful in our previous experience. And then contractor bids is going to be the bid thing. So if you have no previous experience, this is just a little bit of a wild guess early on, as you dive deeper into the due diligence process, way before you close the deal, you're going to want to start getting contractors out there when you start trying to determine what it is you want to do, how the business plan is going to run. Here's what we want to fix. Here's what we want to renovate. Here's what I want XYZ to look like. Then, okay, let's get a contractor out. Tell me this particular unit, this particular style, this particular square footage, this kind of cabinet, this kind of countertop, this kind of appliance, this kind of flooring. What's that going to cost? What's that going to look like? Can you give me a time frame? And then you get a deeper understanding of what that looks like. So when you go back to pitch it, and when you're officially pitching it on a webinar or going back to communicate with this investor that's asked the question, you're able to have a deeper understanding of what the heck was going on and what is going on. And here's how you know what's going on, because you have hard quotes from contractors who have walked the property, and this is how much they're saying they can do it for. So that's that. Question number 8, is there a line item in the budget for contingencies? And this goes back to what we're talking about with the whole buffer zone. So contingencies, that goes back to the kind of the insurance question of making sure you have plenty of just extra meat on the bones. And sometimes it's hard to do, especially in the way that the market is right now, trying to find potential opportunities. And they're few and far between because competition is so crazy and freaking deals are selling for way over asking. So it's hard to put a decent buffer on it and still be able to be competitive and win the deal to ultimately be able to close the deal, right? So that's when, of course, the off-market pieces and different things we'll talk about later come into play. But there needs to be some level of comfortable contingency. And I'll just give an example of why there needs to be. We recently closed our Ono flip. I don't know if you guys saw my post on social media, but we went full cycle on that deal. Took about 14 months to go full cycle as opposed to the 6 to 9 months we thought it was going to take. So there's contingency number one you should always equate for. Then we closed it in April of 21, and that's when we bought it. And then we didn't sell it until this month, June of 22. And so over the course of the last 14 months, lumber was gone up crazy. Material prices have gone up insane. Labor prices have gone up. Just overall inflation in general has gone up. And we didn't account for any of that. So that was another contingency that was another unforeseen, where we should have had a little bit more meat on the bone for that. And so whereas our initial thought of how long it was going to take to renovate being the 6 to 9 months, and the cost, we thought it was going to be 200,000. It ended up being about 330,000 to do everything we needed to do, and took a little bit longer. And then we had some complications with the actual buyer and different lenders that they were going through the process with. So the continued holding costs for that flip was another contingency. We maybe should have thought about a little bit more, because we ended up having to put over $300,000 of our own capital into the deal just to keep it afloat, just to keep the deal going. So all that to say, those were 3 different contingencies where there should have been, a line item in the budget for contingencies, but there wasn't necessarily. But what we did do correctly when we bought this deal was we bought it so cheaply, and we bought it such a discount, and there was so much meat on the bone when we bought it, that even though we didn't have all those contingencies in place, we still came out on top. We're still able to give pretty decent returns to our investors, and we got not nearly as much money as we had hoped for, but we made money, right? We got our $300,000 back. So thank goodness we didn't lose anything. And then we made a little bit of money on top of that. So all that to say, the whole contingency aspect, there needs to be some line item in there somewhere. And even if there's not a line item, in terms of just the reserves you've set aside, that could be there, as well as like, hey, we're going to raise a little bit of extra money for this deal, or we've underwritten so conservatively in terms of, hey, look, market rents are at $1,000 a month right now. But where this property is, the property is at $700 a month in rent. And what we're estimating is that over the next 3 years, we're going to be at where market rents are today in 3 years from now. Now, if someone tries to tell you that's not conservative, they're insane. That is very conservative. And so even if you just start explaining that to them and you maybe don't have a specific line item of contingency in there, that level of conservatism there, that is the contingency of like, hey, we really feel like this is worst case scenario of where we're going to pan out and what it's going to look like over the next 3 years, because market rents are already at 1,000. So, and we're $300 below that, saying we're going to get there in 3 years. So there's that. Next question is question number 9. What exit cap rate are you assuming for the sale of the asset? And how did you actually arrive at that exit cap rate? The exit cap rate is something that you'll just have to have a deeper understanding of the market and deeper understanding of the property that you're buying to be able to determine what the exit cap rate may or may not look like on a conservative basis, but also on a logistical basis. So what the typical rule of thumb is in terms of exit cap rate is every year that you hold the deal, you want to assume that you're going to go up 10 basis points year over year. So when you first buy the asset, let's say you're buying it at 6 cap and you're looking to sell the deal in year 5, you want to assume that you're going to be at 6.5% exit cap to conservatively say you're going to be in a worse market condition in the next 5 years when we sell. And even in a worse market condition, we're still going to come out with the numbers that we're projecting to you today. So that's what that would look like when they're asking about the exit cap rate. How did you come up with that number? And then when they talk about that and you've got a really deep understanding of cap rates in your market, you can start talking about that. Like, hey, well, we're buying this particular deal at a 6 cap, but every deal in the market is currently being bought at a 4 cap. And even if the market does get worse over the next 5 years, we don't think it's going to get as worse as 6.5, what we're estimating the sale to be. So our level of conservatism is just that much higher. Or even if you're not trying to be that conservative and you're trying to be a little bit more aggressive, but it really wouldn't be aggressive if the market is at a 4 cap. Like we bought deals before that we bought the deal at an 8 cap. It was in Montgomery, Alabama, but all of the comparable sale deals in that area were selling at like 6.5. And we had just bought this one at 8. So our exit cap was estimated to be around, I think, 7.5%. So we actually went 50 basis points lesser instead of higher, but that was because market was at 6.5. So over the next couple of years, over the life of the deal, we're estimating it was going to be at that. But then on the flip side, that particular deal was a perpetuity deal. So it was like, here's where we expect the exit cap rate to be. But the only thing that this is really going to be influencing is our ability to get the property appraised for what it needs to be and force the appreciation so we can pull out your equity. And here's how confident we feel we're going to be able to do that. So that's question number 9. And the last one, question number 10. What is the plan if there's an adverse market cycle when it comes time to sell? 5 years from now, you're telling me we're going to sell. 5 years later, when it comes time to actually sell, and the market is in a horrible position, and there's absolutely no possible way that you're going to be able to sell it for even what you bought for it, right? They're thinking worst case scenario. What are we going to do? Are you going to still sell it and we just lose a bunch of money? Are you going to hold on to it? Do we have the capacity, the ability to continue to hold on to it? What is that going to look like? And so that's when you would start telling them more specifically about the business plan, your understanding of the market, as well as what that contingency may look like. Like, okay, here's the specific kind of lending we're going to get, right? So we're telling you this is going to be a 5-year sell, a 5-year plan. But what we're doing to build in a buffer there, the contingency in the case that there is some form of an adverse market cycle and lending is crazy, so you can't really do a refi and you can't really sell. So do we have the capacity to continue holding on to it, or is the mortgage going to come due and we're all screwed? So that's when you would say, well, we're actually going to get a 7-year term loan or a 10-year term loan or a 5-year term loan with the ability to extend another 1, 2, 3, 4, 5 years. So if that comes to fruition, if something crazy happens when it comes time to sell, we'll be able, like we'll already have that exit strategy, that contingency in place that we're able to continue holding. Worst case scenario, rents may plateau. We're just going to continue to cash flow at where we're at. Sure, the IRR may be a little bit lower. We may not be able to return your capital as quickly as we initially anticipated, but we're not going to lose money, right? We're just going to continue cash flowing. We're going to wait out the cycle. We've got a couple of years buffer there to make sure that we get where we need to be. And that would be your safety net, right? That would be your plan for this adverse market cycle. So that's it. That's the 10 questions about a few different 10 specific different questions that investors or brokers or someone of that sort may potentially ask you when looking to invest with you.